Let's get in T.Badshah, Senior VP of and co-head of the Motilal Oswal Asset Management. He joins us right now on the show. Tahir, as always, good having you. Thanks much for joining in.
Thank you.
What are you doing right now? Are you accumulating if you were indeed sitting on cash, or do you believe there could be downsides after earnings season is over?
I think our approach is once again remains stock or probably sector specific, and probably we still see opportunities across a few sectors which we believe look promising. And so if there's any incremental money, and clearly that will probably be directed towards some of those sectors. I take your point that we've had a fairly stable market given the kind of volatility that we've had. So clearly the market movement even in the very near future will probably be guided still up to how the result season pans out, and a lot of it is left yet. But after which we'll probably once again get back into focus onto growth reviving in the economy. So hard to say whether the market will really come off post result season.
Tahir, afternoon. You've got Credit Suisse, which certainly hasn't painted a very rosy picture when it comes to the cement space. They say the June quarter earnings will be weak. The higher cost and the falling volumes will also impact the numbers substantially. What's your call on this basket, and which are your top picks from the space?
We currently are not positioned in the cement sector at all, but my personal view is that, of course, the expectations on the results of these companies is not something which is completely out of context. Of course, there is a good level of expectation that cement companies will probably not be doing very well this quarter, given the slackness in demand, and probably the slackness might persist for a couple of more months up until the monsoon season is we're through with that. So, but I think probably any weakness in this market, in this sector during the next foreseeable future should probably be used as an opportunity, because I at least kind of believe that we will probably see an improvement in demand going into the busy season, led by essentially more public spending, which probably the government will undertake prior to elections.
Tahir, I take your point, of course, about there being selective sectors where there is still money to be made. Now, a couple of those sectors where people have made money the recent past couple of months are IT and consumption, FMCG essentially. Is there still money to be made in consumption? The stocks are trading at 30, 35, 40, 50p.
Probably not as much in the frontline FMCG names, but you would one can definitely still find a few of the mid-sized tangential opportunities in FMCG which could probably make sense. So it will still be a very case-by-case stock-specific approach even in that sector. But we do find some of the mid-sized names attractive in the FMCG space. Apart from that, of course, IT is clearly something which has made money, and we believe that that sector still holds a much more promise as we get into the next 12 months.
Why do you think Reliance isn't getting a stronger response to its numbers?
Basically, this quarter has ended up with a fairly decent growth of nearly about 20% year on year. Probably the same may not be true for the subsequent quarters of this fiscal year, because they will have to contend with a little bit of base effect as well as we get into the 2Q and the second half. So annual numbers will probably be a little muted. Besides, of course, the story in terms of earnings recovery will probably be manifest itself more into FY15, so that's still some way off. And in the recent past, we've seen the stock do reasonably well compared to the rest of the market. So I think that's probably the reason why it's taking a little bit of a pause and a breather. But I still think it is probably good for a FY15 kind of a story.
What did you make of RBI's moves on the overall banking sector? Because Moody's has gone all out saying that it's credit negative for the overall banking space.
Very confusing. I mean, it is probably leaving more questions than it answers after the move. So clearly that's something which will become the most important event as we get into the RBI policy towards the end of the month. It's very difficult to interpret as to what's going on in RBI's mind. Are they trying to essentially stabilize currency at the short end, and at the same time also give a signal that things are going to be tighter as we go along? So it's throwing up quite a lot of confusing signals, especially the next move after that, which was basically the bond auction, which for the reverse OMO, which again threw up a lot of confusion, given that they did not accept the bids at high yields. So it's anybody's guess at this point in time as to what the RBI wants to communicate, and we'll probably have to wait for the credit policy to seek some further details on that.
Before we let you go, though, Tahir, a stock that has been hammered out of shape the last 2 days is BHEL. Now, what could the worries be? Would it essentially be your order inflow, and therefore would it impact the entire beleaguered cap goods space, or do you believe these concerns would be restricted to the PSU ones?
So it's probably more than the PSU factor. It is obviously the fact that BHEL has got an exposure to a single segment alone. So clearly, single segment plays, especially those which are more geared largely to power, are in for rocky times. So I don't think it can be said the same thing can be said about all other plays in this segment. Maybe we'll have to probably wait and see how Larsen fares, but in the upcoming results. But that probably has always stood out simply because of the diversified nature of the business configuration. So I think in BHEL's case, it is yes largely to do with the power segment exposure that they have, and obviously the slackness in demand out there.
Thanks very much, Tahir, for joining in and giving us all of your fundamental expertise on the show.